Well, you know, it's interesting. We watched yesterday, continuing today, even though we're off our highs when it comes to stocks, Cathie, it seemed the more Jay Powell talked, the more, you know, excitement you saw and moves to the upside when it came to both stocks and bonds. Does this market reaction make sense to you, or do you see some irrational exuberance, if you will?
No, if anything, I saw an exaggerated reaction last year to fears that inflation and interest rates were embedded in the system like they were in the 70s. And we just didn't believe that at all. In fact, we were seeing a lot of early signs of inflation coming down, actual deflation surfacing. So this does not surprise us. I think what has happened here, there are three people who have weighed in the last week who really have changed their points of view. One is Larry Summers. Larry Summers was almost apoplectic last year. So this is the former Treasury Secretary, right. Almost apoplectic about inflation. And I think he truly influenced the Fed because he was so sure that we were in a 70s style inflation. If you'll notice in the last week, he said, okay, now don't signal what you're going to do in the future. We're seeing some economic weakness here. And I think the other thing he was saying, not explicitly, was, hey, some prices are coming down that I didn't expect to come down. You know, the oil price is roughly half of where it was last March. So that's the first person. The second person was Treasury Secretary Janet Yellen. And remember, I think the market last year got really upset when she changed her mind on transitory. And I think that fed Chairman Powell as well, and turned him into an even more hawkish mode, along with the rest of the board members. She this week said that now that inflation is coming down, we're probably going to be looking at the bigger risk being kind of mired in low inflation, low growth. That was a big change. And it effectively says, wow, maybe it was transitory after all. It was just a little longer than we expected. Who knew supply chain problems would last 2 to 3 years? Who knew Russia would invade Ukraine? And then the third thing that happened, this was really important, I think, in the Q&A, Chairman Powell himself said, I agree with Lyle Brainerd. We do not believe we're in the middle of a wage price spiral. And that's another code phrase for the 70s style inflation. So I think that is what the market's responding to.
Cathie, you've talked about, though, the threat of deflation. So what's your view on that versus inflation right here?
A couple of things. We see the deflation in the pipeline because commodity prices, which are at the top of the funnel, have been coming down on balance. Now, we're seeing right now some interruptions in that as China moves away from its zero COVID policy. But I think the fake out here is China has been building inventories, particularly of energy. It's been getting Russia's energy for a 40% discount to what the rest of us are paying. So why wouldn't it build inventories? So I think that fear is probably going to be, or has been, a little overblown in terms of ramifications for inflation. And I also don't think China's taking off. But anyway, we have the funnel. We had at holiday time massive discounting. And even though we had massive discounting in the fourth quarter, inventory accumulation accelerated. That was the biggest surprise to me. Wait a minute, final sales were that punk, that inventories built, even though retailers and others were trying to clear the shelves with these massive discounts. That was very interesting to me. So I think underlying demand here is basically the consumer is railing against price increases because real average wages have gone down. And the consumer is going to win this battle.
Cathie, I want to go back to the way that you characterized what we heard from the Fed and Jay Powell yesterday, because he also said some other things, like further rate hikes will be appropriate. It's premature to declare victory. We have a lot of work left to do. And if our outlook turns true, then I don't see us cutting rates this year. What convinces you that his views have changed.
Well, I think he is looking at the bond market, and he's saying what he should say as a Fed chairman who has been very concerned about inflation. He can't turn on a dime. But just look at what the bond market's saying. The long-term bond yield peaked in October at 4.3%. And today we got down to, I believe, 3.35%. You know, if you look at the 10-year bond yield as a proxy for what effectively nominal GDP, give or take a little, nominal GDP growth will be over the next 10 years. That doesn't leave a lot of room for much inflation if we're going to have real growth over the next 10 years. So I think the markets are speaking loudly. I think the inverted yield curve, we're still around 70 basis points. We haven't seen it this low since the early 80s when Volcker was trying to strangle inflation out of the system, and he did so successfully.
So, Cathie, forgive me. I want to jump in for a second. Because so are you expecting the Fed to cut rates this year?
I would not be surprised to see the Fed cut rates this year. And one of the other reasons that we're very focused on this message that the bigger risk is deflation, it's also a very big opportunity. When we look at deflation, there's good deflation and there's bad deflation. The bad deflation is caused by demand destruction. The good deflation creates demand. And that is what our research is centered on, which is technologically enabled innovation that rides down learning curves, which are expressed by cost declines, which turn into price declines. You'll notice that Tesla is cutting prices, and many people jump to the conclusion that, oh, they're having so much trouble now. There's so much more competition. No, Tesla can cut prices now that supply chain issues are passing us because it is riding down a cost curve. The battery cost curve declines. And I think its battery costs are lower than anyone else's. Its drivetrain costs, is more correctly said, are lower than anyone's out there.
Right.
And so he wants to proliferate electric vehicles to save us from environmental disaster. That is his mission. And he is going to drive down prices. When you drive down prices, units explode. It's no surprise to us. Even without price cuts last year, that electric vehicle demand was up more than 60%, while gas-powered demand was down, I believe, 7%. Yep. The consumer preference shift has occurred. We are now in prime time for electric vehicles.
I want to go back to Tesla in a moment, but I want to go back to your Ark Innovation ETF. We've done the story on Bloomberg. You guys had the best month on record for the fund, up 28%. All Ark ETFs, all of the eight ETFs are up, 7 of them in double digits. Do you see that as vindication for your investment theses? And do you think it can continue?
Yes, we believe that innovation was one of the biggest victims of the massive interest rate increase we saw last year. In less than a year, I think 18-fold increase in interest rates. It was like a massive earthquake. And the other victim, of course, was the other very long duration asset out there, long-term bonds. They were hit, at least through October, if my numbers are correct. The long bond market had not seen that bad a year since the 1700s. You know, we're not talking post-World War II. We're talking about the 1700s. That gives you a sense of the shock to the system. And the shock to our strategy was palpable. Boy, we felt it every time Chairman Powell spoke.
We're speaking with Cathie Wood, CEO of Ark Investment Management. Cathie, Carol just asked you about the performance in January, and she mentioned that it's the best month ever for the Ark Innovation ETF. The thing is that the jump in performance hasn't been met in the way of flows, with investors putting money back into Ark. Perhaps this is because it's been a tough couple of years for the ETF and for many of your ETFs. How do you win them back?
Well, actually, I don't think we lost many investors. I think the shock to most people is how well we held our assets. Our underperformance started in February of 21 when people were starting to get vaccinated, going back to work, and these fears of inflation started to surface. So since February of 21, we have seen a massive down round in our innovation strategies. And in 21, we had very significant inflows, most of which we kept. I think the net was 17 billion that year. Last year, again, a horrific year. I think for the year, our flagship was, so ARKK, was inflows, more than $1.5 billion. And I think that shocked a lot of people. What we saw was averaging down. Many of our loyal shareholders did average down. And I think one of the reasons they did is we were out there every step of the way, giving away our research, reassuring our clients that actually innovation solves problems. And we have so many problems now created by supply chain problems, the war, created by the Fed, and the demand destruction, which is hurting margins, which technology will solve in terms of increasing productivity. And I think because we are so prolific in our research, our analysts are amazing in terms of the kind of original research they're doing. So our clients and others are reading research from us that they're not seeing from anyone else or anyone at all.
And I want to get
even out.
And I want to get into that in a moment because I do love it, Cathie. Like you've got over 150 pages in your big ideas for this year, and it's a lot of things that we talk about. What I do want to ask you though, after a 67% drop in Ark Innovation, the ETF last year, and I know it was a tough year for many assets, do you find any of your investors kind of treating Ark a little bit, more cautiously?
I think one thing that happened last year is we were able, with a number of papers, we called it our ground war. We were trying to help investors and advisors understand that if you take a look at truly disruptive innovation, which is all we do, and you look at other growth portfolios, large cap growth, growth generally, as well as the major benchmarks like the NASDAQ, you won't find much truly disruptive innovation in them. And so as we were getting hit so badly, what we also saw is investors taking tax losses in some of NASDAQ and other strategies and moving into our strategy, which was hit so hard because they did believe that we were going to rebound faster. We were hit the hardest. Our research would suggest that the $200 trillion that we expect by 2030 to be the market valuation placed on disruptive innovation, that hadn't changed. That hadn't changed. And so if you have a 5-year investment time horizon, yes, you move into our strategy. And oh, by the way, we are the new NASDAQ, which is one of the ways we were trying to convey, look, if you want to look at the future and truly disruptive innovation, the way the NASDAQ performed in the 80s and 90s, that's where we went with innovation. Well, okay, look through that now. You will not find the kind of disruptive innovation. It certainly doesn't dominate those indexes. Maybe 25% of them.
Well, that's the perfect segue, Cathie, to get you to weigh in on what we look for from the companies that are reporting this afternoon. Companies like Apple, Alphabet, Amazon. These are not companies that you necessarily are betting on. These are companies that you think can be disrupted. What do you watch for with them? What can they tell us about how the economy is, and what Ark should be looking at?
Yes. Well, when I say we don't own those in our flagship strategy, we do own them in some of our more specialized strategies. But these are the companies that have enjoyed incredible success. They have created big, big markets. And to move up tenfold, 100-fold from here is going to be difficult. We're not saying they're not going to be successful, but we are saying a few things. Take Amazon. Amazon is not a social network. We have moved into a world of social commerce. So we own Shopify. Shopify is supporting Instagram and TikTok and others that have that are taking really social commerce and scaling it. And Amazon will not become a social network. It is not one. It's a good online retailer, and I would put it in a more mature category of online retail. That's not what we do. If you look at Google or Alphabet, everyone's talking about ChatGPT, and we do believe that it is going to put search at risk. Search is 95% of Google's revenues. Now, we also believe, however, that Google is going to harness AI as well. I mean, it owns DeepMind. It is one of the best AI companies in the world. But I think it has been so caught up in fears about legal liability associated with the dangers created by.
What about Microsoft, Cathie? And Microsoft's big investment in ChatGPT, do they have the potential to overtake Google when it comes to search because of the way they are harnessing AI?
I think that's the big threat. I think that's why Sundar went to Code Red at Google. I think they're going to become very aggressive. So yes, we absolutely are focused on what OpenAI and Microsoft are going to do together.
Cathie, one thing is, and, for our TV and our streaming service and YouTube, we've got, the share prices of Apple, Amazon, Meta, and Alphabet up there. I mean, you're looking at Meta up more than 20% today. It was higher at its best levels of the session. I do like how you think about innovation and things that are going to be impacting us in years to come. Is the metaverse something that you guys think about, that this is an important trend, or TBD?
Well, in Japan, we sub-advise a fund for Nikko Asset Management called the Metaverse. So, yes, we are in the very early days of what will become very immersive digital experiences. In fact, we believe that more than half of our spending will end up online as opposed to through physical stores. And that's part of our big ideas this year. Our team, led by Frank Downing and Nick Bruce, have done a terrific job, Andrew, as well, pulling together how this new world is going to work. So absolutely we do. I think what happened with Meta last night, I listened to the call, was fascinating. I think what's happening is Meta has an answer to TikTok. It's Reels, and Reels is taking off. They're also extremely focused on using artificial intelligence as they are activating this platform. And WhatsApp is also becoming a very important platform that they have not monetized, and now they're activating it. So really, really fascinating. And, just to give you a sense, Delta is working through WhatsApp right now to inform passengers when something goes wrong and improving customer service dramatically. So, this could become a very big business use case. So, yes, lots of big markets that Facebook. The other thing that Mark did was use the word efficiency. He must have used 15 times.
Investors liked it.
And in that vein, he was using artificial intelligence as well, because as we in Big Ideas, and you can find Big Ideas on ark-invest.com. In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered.
Right.
The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. I think a lot of the hype is in companies that have AI in their names.
We talk about
but I
that
think
all
the
the
real
time.
winners, I know the real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
In your Big Ideas paper, you, again, speaking of big ideas, and I love when we talk about this because everybody on Twitter has a comment, but you stick to your $1 million Bitcoin forecast, despite what we saw, I think about a 65% drop in it last year. People are saying to me, really? Did she really stick to this? Why the confidence in that, despite everything?
Well, the confidence actually was strengthened last year. Now, last year was a terrible year for everything crypto. But if you think about what happened, it was the centralized, opaque players who went bankrupt: FTX, Celsius, 3 Arrows Capital. And what did we see from Bitcoin? Bitcoin is completely decentralized and transparent. It started because of 0809, the lack of transparency in the traditional financial services ecosystem. And I remember when we did our research, and Art Laffer, I mentioned him the first time he was on your show.
Yep.
He took us through what Bitcoin meant to him, and it was, wow, Art. This is a rules-based monetary, it's a rules-based digital monetary system, and it's global, and there's no human intervention. It's very disciplined. It's mathematically metered to top out at 21 million units. Well, in the last year, in the last 3 years, the responses to COVID, the fiscal and monetary responses that, in many countries are causing hyperinflation and, fiscal crises. We're seeing protests and riots all over the place. Well, where do these people go for an insurance policy against an implosion in their purchasing power and wealth? It is in something like Bitcoin. Bitcoin is an insurance policy, and it is an insurance policy for everyone against confiscation of wealth.